Hello, welcome to Successful Tradings. Hey, this is Telex here. I just finished writing the article Debit Spread Explained for Beginner Traders. This is in our series of providing strategies for beginner traders with small accounts. So in this video, I'm going to show you in detail how to use debit spread as a strategy for an option trader with a small account. I will provide you an illustration with an example of for the stock FIG, which has an earning in a few this afternoon, literally in less than an hour, and then we will tackle the exit strategy that many have been wondering about. So this is what you are looking at here. So without any further ado, let us go ahead and dive in. So I'm going to go directly through Weibo. The article is on successfultrading.com. It has so many details. So here is the practical way of actually how to build your debit spread if you haven't done that before. Everything is explained again on the article that we just published. So I come on here. I'm using FIG because it has earning, and we know when as we trade options, hey, implied volatility is high. So as of now, this one is not that bad. I was actually surprised. We can see here through the option chain, some of these are expensive, let's be honest, but implied volatility, we have seen worse, right? We have seen things in the 150 of the like. Here 89%, and the percentile is 33%, meaning what does this mean? Let me take an opportunity here to teach, as you know we do here at Successful Tradings. It means historically, right, it's only ranked, the implied volatility is just only at the 33% level, meaning that if you go from a range of 1 to 100, 100 being the most expensive, yeah, this here today is just ranked at 33%. So it's not actually that bad at all. So where do you go for in order for you to build a debit spread on Weibo? So here I come on here, selected my stock, then I go to option. The first tab here, it's option discover. So here option discover, you have all of this strategy that you can build: long call, cover call, and so forth. We will tackle on cover call next week, and the cash secure puts is already, I think we built an article on that we shared last week. So here I'm going to select my under spread strategy. So they are showing us 4 of them here. So long call spread. So this is a scenario where we know, okay, well, we are bullish on the stock. So the advantage of building a spread is not to spend so much money, lesser amount than if you just buy calls straight up. Yeah, that's what it is. So it consists of 2 legs, as you already know. So we are buying 1 call. Here's the strike price, and the other leg is we are selling a call. So a tip on here, on your broker, right? When you are building this strategy, build it as a single strategy. Do not just go and buy something at a strike and then sell something as a strike. No. Build this at, they will give you a debit spread with a specific strike price, as you see here. On E-Trade, same thing. E-Trade will give you the 2 strike, that so they have several combinations of a strike. So I've been talking with somebody on YouTube since yesterday who actually had some feedback regarding the B spread, meaning that I think one of his feedback was that, oh well, the amount of profit is always limited. Yeah, but I mean, we control how much we're spending, right? So in this case here, I want us to go build something. I've been simulating this. So this is our profit. This is our profile chart, right? So for this horizontal or vertically, we have the price. So the price here are ranging from 55 to 79. So as of now, the stock is trading at 67.27, up 2.59% before earnings in less than an hour. So here is telling us that the implied move, I mean, based on empirical data, it's supposed to be, the stock is supposed to vary between 56 and 78. So for us, the goal here, again, remember, as a small account trader, beginner with a small account, the goal is not to spend more than what? 5% on a trade, on any given trade. So we are going to be quite challenged here because implied volatility has gone up a little bit. So if I want to do that, so two things that I want us to look at here, actually three things. I want you to look at the max loss. The max loss here means the amount of money that we will be spending, right? Because we are buying something, so that will be debiting money from our account. Then we are selling something that will be receiving money. So the combination of those two things will be our overall risk here. So that's what I'm going to do here. So let's say we are buying, here I'm using 2-day expiration is enough, but really in the article we explain, okay, you can be conservative and look at things for 4 weeks away, 3 weeks away, and so forth. But really, for the sake of illustration here, I want just to show you what's possible on here. So have our expiration dates in 2 days, September the 5th. Then let's say we choose the strike price for the call that we are buying. This call right now, we could see how much it is worth. As I'm going to just look at it and let you know. I'm not going to look at it on the screen here. I have a secondary screen. So FIG right now, the 67 call expiring on September the 5th, it's actually going for how much? 67. That's quite just, it's not quite in money. $4.30. Okay, $4.30. That's $430 in an account that's $500 or so. That's no, we cannot buy that contract. That's a major gamble. Wait, that's not. Now with the help of Debit spread, I'm going to say, okay, if I'm buying this one, let me pick a strike that I want to sell and see. Notice how my risk here, max loss, is the risk, folks. Yeah, I want us to focus on that because that's the primary goal. Then we will tackle on the debit. So the gentleman earlier on Twitter was talking about, it was strictly focusing on $1 spread. So I say, well, what's the big deal with just focusing on $1 spread? Here is a very good example. I like this one. Yeah, so because I'm obeying to his rule of $1 spread. So here's a $1 spread. When they say $1 spread, meaning that there's only $1 difference between the two strike that you're choosing, the one that you're buying and the one that you're selling. So here for us, it's as of now, you notice how the market's about to close, folks. Implied volatility is spiking up, yeah, meaning that these contracts are becoming more and more expensive, and the spread, even the spread on FIG is not that nice, because let's say even like 30 cents on some of those, but that's fine. So as of you saw that it was $35 here at some point when we first came on screen. So as of now, okay, it just jumped to 45. So the risk here to get this long call spread on FIG just an hour before it's earning, it's about $45, yeah, that you can spend out of your account. Okay, you're approaching close to 10%, less than 10%, 9% of the accounts. If you can get this for 40, that would be 35, as we saw earlier, would be great. And then the max profit being 55. So I want, at least for me, I don't take a trade because I know that I see that the maximum trade is going to pay me a lot of money. No, I look at percentage. So my friend here is telling me if I'm risking, let's say $40 to $45, and my profit here, I can go all the way to 55. This means that the profit can go above the theoretical profit here. It's above 100%. Yeah. So 110%, that's not bad. Even if you're able to get only 80% of it, that's not bad at all. So instead of the conversation that I got was, you cannot make $100 on a debit spread with just $1, right? That's not the goal. The ultimate goal is to have a high probability trade, which leads us to this one here. Look at the probability of winning. It's not saying that that's what's going to happen. You just hold the hover there. So in this case here, 49%. It's not that bad. It's not that bad at all. So this is it for a beginner trader, how to set up a debit spread, a long debit spread, if you are bullish on a stock such as this one. It enable you with small capital to be able actually to participate and build your position. Because if you're able to get these wins, 100% here, 80% here and there, and accumulate them, you will go a long way into growing your account, and more importantly, not blowing it up such that you're always in the game. That's really the key on here that we want to take today. So again, I can play with this. If now either I take more contract, for instance, notice here, now that I open my spread up with $3, my risk is a little bit more, yeah, but the payout it has increased as well. The maximum profit has increased as well. So playing with this tool, as you can see here, to determine your risk level based on that type of account that you have got. That's all we had for you today. Please, you can download all of these tools on the toolbox. We have been putting them on the YouTube channel, and please subscribe because that helps us grow with you just as you're growing your account. Bye bye.